I feel a bit like Janet Jackson at the moment. I don't know. No, I don't. Just hoping I don't have a wardrobe malfunction and show some stuff that I shouldn't. But good evening. It's good to have you all join us. Is this a bit better? Okay. Trying to self-regulate here, which is quite difficult. So thank you all for joining us this evening at our annual investment conference. I think those of you who have been clients of GMI for many years, you may notice that we have shifted the conference to kind of closer to the middle of the year. We normally used to have it at kind of October, November, and people would take all that information and go on holiday and not know what to do with that. So we thought we'd move it to, during like working hours, like August to September, October, that you can act on the information. But it's actually a pleasure to be having a conference like this in the environment that we're having. We haven't had the kind of environment that we have now for many years. I've always started the conference almost, kind of apologizing to people that, despite everything that's happening, but this year it's different. It feels different. There's a lot more smiling faces. I think you got your statements in the post. Things are looking better. Some double digits appearing on the statements again. But yeah, I mean, the JSE hit an all-time high today, this morning. The interest rate print came out yesterday. It's the lowest it's been in 3 years. The rand-dollar exchange rate is finally starting with 17 something. It's been over 18, 19. We'll find out later how many consecutive days of electricity we've had. It's a bigger number than we've been expecting. So it just feels like a lot more positivity. The client engagements are a lot more positive. So it's good to have an investment conference against that background, and then also get a sense of, can this last a bit longer? What are some of the things that, as a fund manager, Allan Gray are seeing that perhaps they're more positive or not? We don't know. We'll find out. And then for us, it's an incredible honor to have Mr. Dan Marokane join us this evening and agree to address our clients. Dan is the CEO of Eskom, and I will introduce him later. But I think certainly there were a few of our clients who are in the solar industry who said they were coming, but I don't see that they're not here. So I think your security detail can relax. Those guys, the angry guys, are not here. So our agenda for this evening is quite a short one. We thought we would reduce the number of speakers and give the audience more of a chance to engage with the speakers. We found over the years that our clients like to ask questions, so we've made time for that. So after my introduction, I'm going to hand over to Siphesihle Zwane, who's one of the portfolio managers at Allan Gray, and then I'll introduce Dan from Eskom. Then we'll have a short break, and then I'll do a business update, and we'll have a Q&A session with myself and the two speakers. Just some formalities. The gents and the ladies out the door to the right, short left ladies, and then gents a little further short left. And you'll be at the gents, and then cell phones, if you could put your cell phones on silent. We'd appreciate that. And yeah, so without further ado, let me introduce Siphesihle. Sipe has been a portfolio manager. He's been at Allan Gray for 6 years. He's a portfolio manager on the South African equity side. So Sipe, over to you. I think you've got that. I think you use that here.
Okay. Good evening, everyone, and thank you for joining us. I feel like a Jackson, but I don't know which one. I'm definitely not Janet with this mic. Let's see if let's figure out where to point this. Okay, so I'm just going to talk about the investing environment, and the way we think about it is probabilistically, right? So we think about outcomes, what are the possibilities that could happen, because we know we can't tell the future. It's a very difficult thing to do, and there's very different things that could happen in the world and South Africa. So the way we think about this is how likely is it that X happens, and if X happens, what does that mean, and how do you position yourself for it? So you have different outcomes, and we think about investing in a probabilistic way, focusing on decision making rather than just the outcomes. And outcomes definitely matter, but if you make the right decisions for long enough, then that tends to come through as well. So I think to start, we are very small in the global environment, and as much as things are getting a bit more exciting here and the sentiment is better, the world does feel more uncertain, right? You have that man in the top right there who took the best picture of this decade. You have, the whole energy shortage globally, and energy markets are quite tight in general. You have the energy transition, which matters quite a lot for South Africa and a lot for the developing world, and how Europeans think about that as well. And you have like currencies, the dollar's place in the world is something that people are questioning quite a bit. So it's an increasingly uncertain world. This is one big reason. So 2024, these are all the countries that went to some sort of vote in this year. So going to or have, so about 50% of the world population. So it does make sense why the news has been very, very interesting. And I guess the US is having their one, the UK had one, and we had one as well. I find this chart quite interesting. So this is strategic competition. So it's the share of global GDP. So at the bottom there, you got the US, and in the purple, you got China. And as these countries start to grow and they bump into each other's territory almost, you find there's more, call it strategic competition. So tariffs are a big thing. People are friendshoring, so bringing in production chains closer to home. You know what the US did with chips for China. All those sort of things matter quite a bit to where the world's going. And this is one of my favorite charts. The blue there is not the color of the ocean, but it's trade routes, right? So ships going in between the world. So the world is very close, right? And it has been for the last 30 years, and now you're finding that a lot of that's splitting, right? So the Red Sea is having their issues. When we speak to a lot of companies, freight rates have increased quite a lot because of that. In Cape Town, our office in the waterfront, just before the last day of the English Premier League last year, we saw the Manchester City's club owner's yacht was parked there, because I think he was very nervous to take that thing into the Red Sea, and he's been coming to South Africa rather than going that direction. So interesting world. Things are dividing. It's more, I think, a nervous world, and there's more volatility as a result. Whereas in South Africa, there's improving sentiment, right? So just some pictures of some sports stars there. A lot of medal winnings, guys, and then you have, obviously, you can't put sport there without putting the spinning in the bottom right there. So in South Africa, improving sentiment. We're very excited as a nation. Some good reasons. So, I mean, the way we think about it is on this distribution. Just use a normal distribution. Obviously, we think about it a bit differently. But I guess the election outcome, we feel you probably moved further away from the left tail, right? So the left tail was deteriorating, sort of the country deteriorating a bit more. And we think the outcome, for reasons, you have more people arguing about different things. The level of debate, I'm sure, amongst our politicians has changed a bit, and accountability has changed. And I guess people have realized that you can get voted out, which is a different way of behaving afterwards. So we've moved more from the left tail and going towards the right. So maybe status quo, getting more reasonable. And there's always a chance that the right tail can happen, which would be amazing for the country. But we feel like you've moved a bit more from the worst outcomes, moving slowly towards the right. And it's something we watch very closely all the time. And then just to talk about, I guess you've had investment conferences before, and the attitude or the feeling is different at different points in time. So I find this quite useful to look at. So this is South African shares versus global shares over the last since 2000, I think it was. South African shares actually have outperformed global shares, and it's weird to think about when you've had the most recent experience. So this is from 2011 till 2024, and the gray there is how well the global stuff is done. So done very well relative to South African shares, but you go back to this, right? This is from 2001 to 2010, and the red there is South African shares, so they did incredibly well. So in our minds, it's always good to think about what are the scenarios where we could have a repeat of something like this? What could possibly happen that could lead to these sort of outcomes? Sitting in 2001, most people probably didn't expect that, but we had incredible growth, a whole lot of malls everywhere. ShopRite was opening a store a week or whatever it was. It was an incredible time for South African shares, and people rated them lowly at the beginning because expectations were low, which also matters quite a bit. The expectations do matter. And then this is just a shorter term thing, so the GNU rally. So this is the 10 days going into the elections is the gray there. So as people saw that the ANC is losing by more than they expected, then people are very nervous about the country. Then this whole GNU thing started, and so that's since the GNU was announced how much share prices of some South African companies have gone up, which is incredible. So those are sort of Nedbank, ShopRite, Mr. Price, Hyprop, so these very South African Inc. type businesses. So the way we're thinking about it, so obviously there's improved sentiment, but we're fighting some tough underlying issues. So I think of us more of a Hugo Bruce's Bafana. So I like the way they play, the guys have improved, they've got some heart, but for them to compete in the world stage, a lot needs to happen. There needs to be a lot of improvement. It's almost like a generational thing, and there's a lot of hard underlying difficult issues that you're fighting, even though we can see this improvement. So this is the one chart we like to look at. So this is the 10-year government bond yields, and you can see it's come down a bit towards the end there, but this is how much people want to be paid to give us money as a country. And it's a good indication. So from 2013, where it's gone, and there's some good reasons for this, right? So this is one. So this is the 5-year change in government debt as a percentage of GDP. And this is us compared to emerging markets. You have Colombia there, you have Mexico. The tricky thing here is, even if we spend the amount of revenue we generated, because our interest rate is higher than our growth rate, we still have to borrow more money just to pay our interest on an ongoing basis. And then we try to cut spending. And what tends to happen is, people will publish the CapEx budgets in the beginning of the year, and we tend to cut in the wrong spaces. So we cut in the things that our infrastructure spending, for example, which are the things we need for growth. So then it's a very tricky environment where you almost have to spend more, but at the same time, it's expensive to spend, and people worry about this, but you need the spending to grow. So it's a very difficult environment we find ourselves in. And at the same time, the people who've been funding the show, so every year the deficit grows, it's quite a big deficit at the moment. It's been mostly the South African savings industry, savings pool, and that shrunk as a percentage of GDP. It used to be, I think, about 5 or 6% per year cash flows as a percentage of GDP, and that's gone down to about 4.3%, I think, ongoing. What that means is there's less people to take on the additional government debt because, if you look at most fund managers, they full on SA bonds. They probably wouldn't want to increase their weighting by much. So to incentivize the people to take up more, interest rates keep having to go up. And that's what when you see in the chart here. And usually before it's like, oh, it's okay. The foreigners will come in and they'll save us. The interest rates were close to zero there. They were happy to take some risk in Africa. But that's not the case anymore. So if you look at this is the percentage of bond ownership by foreigners or non-locals over time. I think if you actually look at the latest data, it's probably gone up a bit. And those sort of things help quite a bit. But in a world where we're struggling to finance ourselves, to incentivize people to take up the bonds, interest rates have to go up. And then this is just, tied to that, the equity risk premium. So shares haven't outperformed bonds by much, and versus the history of South Africa as well. And I mean, the main reason of that is just, bonds have done well because you have to incentivize people to actually hold that in their portfolios. So then how do we position ourselves for this? It's an interesting thing, right? So you have the excitement that's coming through, things are improving, but at the same time, we're fighting against very difficult long-term challenges. So again, we focus on making the right decisions, understanding that the outcomes will vary uncertain, the world is uncertain. So one way we think about it, what are you actually buying when you invest in the JSE? Actually, a lot of the shares are not driven by South Africa. So it's outside of South Africa fundamentals. So, I mean, you have a few there, but like you have mining, right? Mining is almost completely China, except for diamonds, which is the US, which is, very small and doing quite badly at the moment. You have the multinationals, you have things like AB InBev, British American Tobacco. South Africa doesn't matter much to them. And you have processed naspers, which is China as well. So what does that mean? China becomes quite important to the South African economy and our markets. So in our thinking of how we position ourselves, we actually think about how much our exposure is effectively to China. So we have quite a big position in British American Tobacco, less so in things like BHP Billiton and Richmond, because that economy is slowing down, there's geopolitical tensions there, and they could have meaningful investments in South Africa. Then we try to diversify, right? So think of different outcomes. We think of, limiting the downside risk, which is an important one for us. So even if we miss out a bit on the upside, we think if you limit the downside risk over long enough periods of time, your skill comes through. So focus on valuations, don't get too excited when other people get too excited, and then look at the actual fundamentals of the businesses. And actually the way this is played out over time is this. So this is one of my favorite charts. So this is our 3 biggest funds. So if we take, I guess, the last one, so that's an equity fund. The first part there is the up months. So when the market's going up, how does our fund perform? So the darker there, so the darker there, so that the number with the 34 there, that's we underperform when the market goes up. And then you could have the middle part, or the middle charts there, and also the down months, right? So when the market falls, 3.3% versus 1.8 for the same fund. So by protecting capital, by focusing on valuations, you miss out sometimes on the exciting stuff. But it's hard to have a good view of the exciting stuff, because I mean that's it's just excitement. So we try very hard to research the companies and think about the underlying fundamentals and justify a valuation. And then sometimes you miss out on the way up, but you protect capital on the way down. And then you put that together, and then the funds tend to do better than their benchmarks over time. So we're way more focused on the downside and being cautious and think about scenarios and willing to let go sometimes of things when they get a bit exciting. And then I think this is quite interesting. So my most experienced colleague, Sandy, he's been in the markets for 53 years, I think. He always reminds us that Allan Gray was built on an investment in Rembrandt. So this is Rembrandt from 1973 to 1987. Definitely not a great time for the South African economy, and how it did relative to the market there and local bonds. So that's Rembrandt in red at 34% return. So sometimes you just do your homework, you research the companies, you have a thought on what people expect, and if you write relative expectations, the economy tends to matter less than you think. It obviously does make a big difference, but you can still outperform by doing your homework. So Allan came back from the US, and he did more research, and South African fund managers were at the time focused on the valuation, and then this share that he found at the time helped build the business, which I find quite interesting. And then, so this is just the overall performance of the same funds. Thank you.